Hello and welcome to the show. I'm Kim Parley. Thank you so much for joining us tonight. Well, it's time for us now to take a deep dive into China. It has been all over the headlines and pretty much the only thing investors have been focusing on. But let's give a little context. From about 1978 until about 2010, China reported 10% annual growth. It was the engine for much of what was happening in the world. Fast forward to today, and Beijing is reporting growth closer to 7%, but a lot of economists, a lot of investors are even questioning that level of growth given the things like falling electricity demand and falling trade volumes and falling volumes being shipped throughout the country. They're just not seeing the kind of mechanics to uphold that number they've been talking about. Add on top of that a Chinese stock market crash and a wobbly currency, and a lot of people are very concerned about what's happening in the world's growth engine. Here to give us some perspective, big picture perspective on what's happening with China, we're joined by Beata Caranci. She is chief economist at TD. Nice to see you again.
Thank you.
What the heck is going on? I mean, first of all, I want to say we are inundated right now with headlines from China. It seems like every day we're getting a bad economic report, a currency devaluation, again, news of a stock market crash. What's going on?
So China, it may seem that when we think of economic growth policies in advanced economies, for example, you lower interest rates, people lend and borrow money. China has much more of a managed economy, and this is why they've had such super cycle growth cycles in the past, because they've been able to fuel a lot of that growth through fiscal stimulus, through targeted lending policies or requirements on lending of banks, which are mostly controlled by the Chinese government itself. So what they've been trying to do in the last, basically 10 years, but more strongly in the last few years, is move more to a liberalization of their markets, opening up their foreign exchange markets, moving to a more market-based lending rate as opposed to a controlled or managed, you lend what we tell you to lend at market rate. And as a result, they're going through an enormous amount of structural adjustment in their economy. And it's occurring at all levels. So fiscally, they're making structural adjustments. Financially, they're making adjustments. And even in public policy, they're making adjustments. You probably saw that they loosened up their one-child policy recently. And that will have a benefit of, over time, 25 years or more, increasing their working age population relative to a very old population in retirement. That's putting pressure on them. But these are all policies that take time, and often the benefits occur in the medium to longer term from these changes that they're making. But the costs or the knee-jerk reaction that you see in markets occurs almost immediate. So they absorb in the near term a lot of the negative impacts of these changes and the benefits in the long term.
Let me ask, I guess, a simple question, which are always the hardest to answer, I think. But so if you have an economy which some may say is responsible for the commodity super cycle boom in 2010, they really spurred that demand on. When you have these structural changes you're talking about, what does that mean then? So in the medium to longer term, yes, it's a move to a more decentralized economy, which is probably supportive in the long run. But in the short run, it looks to me as if people are getting spooked.
Well, and there's, again, going back to that big picture, what's happening with China, nobody's really expecting them to go back to a 9–10% growth rate. That was, a period of time where they were growing at a fast rate and maturing as an economy. And the more you grow and your population becomes oriented into the labor market and real GDP per capita rises, you hit these technology thresholds, much like we have in advanced economies. They're not there yet. But the growth rate cannot be sustained at 9–10%, which was causing those commodity prices to really pop. So we're now into more of a sustainable pace for China. And it's structurally declining because they have a very older workforce as well. So there's some demographic challenges on that front. So you take the two, and what's more reasonable for China? Well, it's more reasonable that they're going to be growing at between 6 and 7% over the next couple of years, as opposed to 9–10% that we've seen in the past. And by its very nature, that means that commodity prices naturally are going to be at a more subdued level. They still remain the biggest importer consumer of commodities. If you look at what they consume for aluminum, zinc, iron ore, copper, they consume more than all of the US, Europe, and Japan combined. But they're not consuming at a growth rate of 10% now. It's at 6 to 7%, and so that naturally lowers the level.
What about when this currency devaluation took place? I'm reading through some headlines, and there are some pretty loud, blaring headlines. Exporting deflation, the beginning of this, and how real? What is the concern there, and what do you watch as an economist to say this is something we should be watching?
Well, the notion of the exporting deflation is that if their currency is depreciating, and we know that, for example, the U.S. imports significantly, and China is a huge player in terms of who they import from, and in fact has been displacing Canada as their imports. So Mexico and China's share of U.S. imports have been rising steadily, and Canada has been falling. So there's this trade-off that's occurring. The concern is, well, if they depreciate and you can bring in those goods a lot cheaper, your import prices are falling, and that feeds to consumer prices. And so overall, your price levels are going to be dropping. And from a policy implication, there's some concern that maybe the Fed won't be raising rates in September.
They're opposite directions right now.
Right, because your inflation levels are getting held so low as a result of this lower prices that are occurring globally. So that's a concern, more so from a policy implication and what it might mean in terms of response. For Canada in particular, though, I think, the more competitive China's goods become relative to ours, the more countries can substitute away, in particular the U.S., and that trend is already underway. And two, if the U.S. moves away from the decision of raising rates because of some of the financial volatility that has been occurring, the Canadian dollar can actually rise. Because it's priced in that the Fed would hike while we were still in the stay steady camp, and that was putting downward pressure on a Canadian dollar. But if the Fed moves off that position, it could actually lift the Canadian dollar, and then again, our exports would be slightly less competitive from a currency perspective.
All right, stay with us. When we come back, we're going to have more with Beata Caranci and get her take on what this could mean for Canada in the longer run. You're watching Money Talk. We'll be right back. Welcome back. I'm here with Beata Caranci, Chief Economist at TD. We're talking about China and the complexity, I think, of changing over from one system to another, what it can mean for the economy. You recently came out with a special report on the Chinese economy and noted a number of headwinds that China's facing as they move forward. And I think this is these structural things you talked about. But one of them was growth dependent on stimulus. And I'm assuming this is government stimulus. And so it was like, we want this industry to grow, we're investing here. So that's going to be changing.
Yeah, well, they're going to try. Yeah. Well, it remains to be seen how successful they are. And it goes to the notion that they've had a lot of their growth coming from, in particular, investment, the property sector in particular. They have a high dependency as a share of their GDP or their economy on investment. It's double the share of the US and most advanced economies in terms of that dependence for growth. Where they have a very low dependency is on the consumer. So their economy, GDP, it's about 40% of it is driven, or of that economy is made up from the consumer spending. Most advanced economies, it's 60 to 70%. So what they're trying to do is this rotation of drivers from an investment side over the consumer side, but that's a tough thing to do when your economy is oriented towards growth in a certain sector. And so some of the policies that they've put in place have been to, not just in terms of fiscal stimulus to try to reorient who's spending in which sectors, but also to bring in more transparency and governance into the lending space. And an example is that they really cracked down on local governments who were lending to property developers to build roads to nowhere. And
was this some of this off-balance sheet stuff?
Yes, yeah. Because the local government, most of their tax revenues come from property development, sales tax, and property sales tax. So they had a strong incentive to see development in their regions, even if it wasn't well destined in terms of being a productive use of resources. Yeah. And a lot of those funds, they got off-balance sheets. This is the shadow banking market. And so the government stepped in and said, no, we need this to be on balance sheet. You need to have transparency. You need to report your income and expenditures and your fiscal status. And as a result of that, you saw lending clamp down. And so, in dealing with some of this not very efficient system, it overcorrected. And then they came back in and said, all right, we're going to allow lending in this space and that space. And so this is part of the push and pull that you get in the Chinese economy, that they put in reform.
It overshoots.
They
come back.
And they get a little bit of cold feet and have to readjust. And maybe it's not even, that's too harsh a criticism. It may not be cold feet. It's this, again, this is new territory for them, and there's a lot of trial and error that's happening in this learning process.
Which is tough when a lot of this is being reacted to in a public market, because you kind of get that overshoot at the same time. You highlighted one thing in the report, talked about skyrocketing, non-financial sector debt of 250%. Is that the debt you're speaking of there, or what does that mean, non-financial?
So non-financial is basically not occurring by banks lending. It's all your corporations, households, and everything that's outside of that.
But it's not the municipalities. Is this different, or some is?
Yes, it would include the municipalities lending into, especially if they're lending over to corporate sectors and developers and everything. And so that's increased tremendously in recent years, and the rate of growth of credit is about 2 times the rate of growth of their economy. And that's usually a flag that when you have that credit to GDP cycle pull away from your historical averages, it's usually a red flag that you're getting into heated or bubble territory, and that you're raising the financial vulnerabilities inside an economy. And in fact, that's exactly what we saw in the US heading into the financial crisis, the very same
This
trend.
is not very comforting, what you're saying.
Well, the difference with China is, unlike the US, they have a heck of a lot of foreign exchange reserves to bail out any sector they want to do. And their central government debt is very low. So they have the means, like we've seen in the past, to step in and do bailouts if loan losses were to rise significantly.
Right, so they can do that. What options, I guess, what are you listening for in terms of what the government's going to be doing next, in terms of just understanding how to have true economic impact? And I know there's hundreds. They're doing so much on every level you imagine, but what stands out for you, maybe a few?
I think we just continue to look for the messaging that they're going to continue along the reform path, and the liberalization and the opening up of their markets. And I guess the question for us, which is hard to judge, is to what degree are they willing to sacrifice economic growth for the reforms? Because whenever it gets a little bit painful, we see them step in and alter those reforms and take a step back. So it's almost like they're doing 2 steps forward and then 1 step back as part of this continuum. But ultimately, this is what puts our judgment that the Chinese economy will grow at about 6 to 7%. If they don't put in the reforms, it's going to raise the risk that they can have a financial crisis down the road, because it's very clear they have extremely high debt levels that they need to address, and they need to rotate this growth away from the investment sector. So we're just continuing to look that they're implementing on that, otherwise the financial vulnerabilities will continue to rise.
Let me ask you, for someone who's listening and said, okay, I understand, there's a lot to understand here, and maybe I'm managing my own portfolio, or I'm talking to someone, I'm a Canadian investor. What is this going to mean for me? You touched on it a bit about, in terms of currency and maybe commodity prices, but what, from a Canadian economy landscape, how is China going to affect us over the next 10 to 15 years?
The commodity prices is the key channel. And I think that, right now we're at a low point in commodities prices, and that's related to the fact that it's not just China, but global demand has been quite low. And that, on a cyclical perspective, should improve as we get out to 2016 and 2017, especially if the US is gaining traction. But ultimately, that commodity super cycle in the past, I think Canadians, thinking about oil getting back up to $100, $140 barrel, it's not going to happen. And, and in fact, we're looking at an oversupplied market and insufficient demand to absorb it. And that's a long-term consideration. So thinking that China's going to step in with faster growth and absorb it, not going to happen. And I don't think going forward, or a very low probability. So from our perspective, commodities will always remain an important part of our economy, but it instills the importance of diversification. And for Canada as a whole, we are ultimately a service-oriented economy. A lot of people forget that because we have so much visibility in terms of oil and commodities in general. Canadian dollar is sometimes thought of as a commodity currency. And so I think for us, focusing away from the influence that China could have on commodity prices in general, and moving towards where is the future growth of the economy, it's usually in the services sector, up the value chain in terms of high-tech, professional technical skills and all those areas, financial services as well. So these are areas that offer a tremendous amount of growth opportunity for the Canadian economy, and we still consider that to be extremely positive outlook in the future.
Economists. We need lots of economists to know what's going on. Beata, thanks so much.
You're welcome.
Beata Karenzi, she's Chief Economist at TD Bank Group.
TD Well.